Hello, this is Joseph, and today I'll be walking through the accounting process of covering journal entries, ledger accounts, trial balances in preparation, and adjusting entries, financial statements, closing entries, and the post-closing trial balance. And I'll explain each step, why it's important, and how it impacts the company. So, for question 1, we had the journal entries and recording transactions. Journal entries are really important in accounting. They're used to record the financial transactions, and each transaction has the rule of debit or credit. For example, if you take the first one, October 1st, the company received an investment of $52,000 cash, a $27,000 computer system, and a $9,000 of office equipment in exchange for common stock. So common stock obviously would be the credit, and the debit would be the $52,000 of cash, $27,000 of computer equipment, and $9,000 of office equipment. And we just repeat all this for the other transactions, following the same rule of the liabilities plus equity equals assets. After that, we take a look at the ledger accounts. The ledger accounts track balances. So, for example, the cash one shows all the increase and decrease in cash. The accounts receivable account shows the amounts owed to the business. And then we can take a look at the computer service revenue. That records the service income. So the trial balance, the importance of the trial balance is that it shows that the debit and credit match up. If they do not match up, that means you either didn't input something or you messed up one of the numbers. So you have to make sure that at the end the debit and credit they equal. So adjusting the entries ensures that the company's financial records are accurate by properly accounting for expenses and revenues and things like that, and at the right time. For example, recording monthly depreciation keeps assets values realistic. So once all the adjustments are made, financial statements like the income statement, the balance sheet, and statement of retained earnings, they give you a clear picture of what the company's profitability is, the financial health, and how the earnings are distributed. So at the end of the period, closing entries reset the value, expense, and dividend accounts and move it over to the retained earnings, which makes the company start with like a fresh cycle, and a new balance sheet. And for the post-closing trial balance, that acts as a final check to make sure that all the balances match keeps the financial records organized and helps business owners make decisions, make good financial decisions based on all the balances. So, for question 2, we had this preparing and posting the journal entries for the December transactions. So again, same thing as the last question. It has the same debit credit rule. All transactions have to add up. I mean, all the debit and credit have to match up. So preparing the adjusting entries. Adjusting entries are made at the end of the accounting period, with the period in which they occur. So after you complete the post-adjusting entries, after you do the adjusting entries, you post them into the ledger. This updates the account balances and prepares the books for creation of the financial statement. Yeah, you just follow the things they gave you. So after you do that, you start preparing an adjusted trial balance. This one was for the December 31st. That just ensures that the total debits and credits match up. Again, if they do not match up, that means you either inputted something wrong, made a mistake in the numbers, or something else like that. So you have to go back, make sure to find that mistake so that the debit and credit both equal. So then you have the income statement. The income statement just reports the company's revenues and expenses to calculate the net income for that period. So it just lists the revenues, then you deduct the expenses, and that leaves you with the net income of $21,672. Then you have the statement of retained earnings. This statement just tracks changes in the retained earnings over the accounting period, and it just shows how the net income and dividends affect the retained earnings. So then you start with the beginning of the retained earnings, you add the net income, subtract the dividend paid, and then you come at the end, you get the ending retained earnings. Step 6 would be the balance sheet. Balance sheet provides a history of the company's financial position. Not even history, but the current state of the company's financial position by listing the assets, the liabilities, and the equity. So you list all the current assets, then you'd list the plant assets, list the current liabilities, list the equity, and again, you'd add those up, liabilities plus equity, and get your total assets. For 7, closing the temporary accounts. For this, you would close the revenues to the income, close the expense, close the income summary, and then close the dividends. Here we have the post-closing trial balance. This just confirms that only the permanent accounts, like the assets, the liabilities, and equity, remain after all the closing entries. For this, you would list all the permanent accounts, confirm all the debits equal the total credits, again, making sure those add up, and then you would ensure that all the temporary accounts are closed. So the last thing would be preparing a post-closing trial balance. A post-close trial balance, that just confirms that only the permanent accounts remain after all the closing entries. Again, for this, you'd list all the permanent accounts, and then confirm that the debit and credit match up. If they don't match up, again, you have to go back, figure out what you did wrong. And this is the final check that ensures that everything you did is correct and you're prepared for the next accounting period.